It's a phenomenal company, not just because you see some very strong returns over the last 10 years sitting at around 400%, but when you think of MasterCard, you're also getting some very strong dividend growth with a dividend increase just this month of 16%, double digits. So let's take a look, find out whether this company is undervalued. Yes, it is at an all-time high, but that doesn't necessarily mean it's overvalued. We're going to look at how the company's performing in terms of their top line revenues, their bottom line net income. We're going to look at the health of this company, their balance sheet, total cash versus total debt. We are really talking about such a phenomenal company. We're also going to run them through our valuation model, give you our thoughts on the intrinsic value and what is not only our acceptable buy price, but what yours would be depending on your investor margin of safety. We're also going to run through how they've performed versus some well-known competitors like Visa over the last 5 years. We're also going to look at their dividend safety, some very important financial metrics that really highlights why this is such a high-quality company that rarely ever dips. And we'll also take a peek at what the institutions are doing and how they are looking for 2023-2024. Now, yes, this is a company, it has been up an incredible 417%. Remember, it doesn't include those dividends reinvested and is pretty much near enough returning what the S&P 500 has year to date. So very positive to see. And yes, we do see it have a yield, a very small 0.63%, but we'll touch upon that when we look at the dividend growth and why having such a small yield is not necessarily a bad thing. Now, when we take a look at the income statement, what we like to see, 3 to 7% growth year on year. Well, December 2018, they reported on their top line 15 billion, very strong. And what we saw in December 2022, their latest annual report, they did in fact increase their bottom line by 50% over the last 5 years. That is very strong, very positive to see. When we take a look on a more granular level, we do see an increase to 2019 before a drop into that COVID year, something that we also saw when we analysed Visa, but it did rebound very nicely all the way to 2022, and we're expecting, based on the December 2023 results, around a 10% increase. This is, however, is just the trailing 12 months, so when we do receive their annual report, we will analyse that. So go ahead, smash that like and subscribe button so you are notified when we do analyse their latest results. So when we scroll down and we take a quick look at their bottom line to see what kind of story we can see, well, 5.9 billion reported on the bottom line in 2018, just under 10 billion. So they in fact nearly doubled their bottom line over the last 5 years. Very similar to the top line, we do see a growth to 2019, that COVID drop, as we mentioned earlier, in terms of essentially the lockdown, people not being able to go and use their cards to buy whatever they would normally do when they're out and about. It then did rebound fairly nicely again into 2022. And again, based on the trailing 12 months, we're expecting another increase similar to the top line of 10%. So very strong, and hopefully you are understanding as we're running through these analytics, these metrics, why these type of companies like Visa as well do trade for a premium. They aren't just trading for a premium for the joke of it. Now, in terms of the balance sheet, total cash versus total debt, around 8.4 billion of cash in 2018. When we compare that to their latest report, so they are holding on slightly less, but still around 7.5 billion at their latest report time. Now, when we compare that 7.5 billion to their total debt, when we look at that numerically and directionally, we see that they had around 6 billion in 2018, and now in their latest report around 16 billion. So they are holding more debt than they did 5 years ago, and in actual fact they hold less cash than they did total debt. When we did review Visa, we actually saw that Visa holds around roughly the same amount of cash than it does debt. Now, in terms of performance, we're just comparing them to some very well-known companies in the transaction and payments processing server industry. We have Visa, we have Fiserv, and an ever so popular PayPal. Now, total return, when we take a look year to date, MasterCard, and remember total return, it does include those dividends reinvested, is one of the top performing there, up 22.43%. We see Visa thereabouts at 25%, with Pfizer, the top performer, there at 32%. Now, interestingly, when we extend that to the last 5 years, what we see, MasterCard has been the best performing, up around 126%. So very, very strong, very positive to see, but always do remember past performance is never really an indicator for the future. Now, before we jump into the safety and dividend metrics, we can take a very quick look at institutional ownership, which sits around 75%. In terms of outflows by these institutions, around 42 billion over the last 12 months, but a significant amount more of inflows during the same period, around 350 billion. So that should tell you a lot that you already need to know. Two things I would point out from this graph that we can see here. Firstly, a lot of inflows by the institutions in Q2 as we see here in 2023. But one thing to note over the last few years, MasterCard isn't a stock that companies or institutions, in fact, do tend to play around with much. They don't trade it, they don't buy and they sell. It is one that they do hold. And there is good reason for that as we are going through these analytics and metrics. It is a very high quality company. Now let's really drill that home with these analytics and metrics we're about to look at. Dividend safety score 99, very safe, 393 billion mega cap company. Now recessionary metrics, for those that see a recession inbound, well, they maintained the dividend during the last recession. Plus 2% sales, fairly positive given the average growth of companies in the S&P 500 was around negative 12 to 13%. And one of the best performing companies during the last recession. Yes, it is a negative return of 12%, but the average the S&P was negative 55. So if you're a regular viewer, you know this is pretty decent in terms of return during a recession. So you could class it as a recession-proof stock. Now, something that really I love, in fact, dividend growth investors would love, double-digit growth consistently over the last 10 years, 16% this year growth, last 5 years 18%, last 10 years 33%. Yes, the yield is small, but it is increasing at such a rapid rate that when you look at it and your yield on cost over time, it is only ever going to increase at a much faster rate. And another thing to note, if you do believe, that this yield is too small, go and have a look at companies that have very high yields. We even did a video on this not too long ago that have high yields and see how they have performed just on a share price return versus these very high increasing dividend growers. On top of that, it is well above that 4% I always say and advocate to get higher than inflation year on year, and we see it increase their dividends for the last 11 years. Now, in terms of dividend yield theory, well, those that are new, it states the company is undervalued when the current yield sits above the 5-year average. So we have one sign of undervaluation here. But remember and bear in mind, we never look at any of these models in isolation and we draw our conclusions towards the end. Now, forward PE, another sign of undervaluation, 30.9 versus the 5-year average of 33.3. But we do see it sitting very high above the financial sector PE ratio. Now, one thing to point out, just because it is sitting at a 52-week low, it is not a signal for overvaluation. Very similar to 52-week lows. We always do mention a 52-week low is also not a signal for or undervaluation. Now, earnings, we always keep this data available for investors, but personally I steer away. It is susceptible to manipulation by management through accounting. Free cash flow below 60%, it means that, in my opinion, management have that ability to offer those double-digit increases we love to see and love to know from MasterCard. And we can pretty much see why they have offered that. Look at how consistently low their free cash flow payout is. 2022, 20%, 2023 expected 22%, 2024 expected 19%. These double-digit increases are expected to continue. And this is something that I do really appreciate from a company like MasterCard. Free cash flow per share, $3.17 in 2013, more than 3 times growth over the last 10 years, $10.40 in 2022, and expected to be pretty much flat in 2023. So it has grown fairly nicely over the last 10 years. Now, sales growth, double digits nearly every single year. Yes, we already discussed that COVID year where it dropped. 23% 2021, 18% in 2022, 13% in 2023 expected. So lots of positive signs. And if you want to see the numbers, well, 8 billion to 22 billion. So very nice, just under 3 times growth over the last 10 years. And if that isn't enough to satisfy you as an investor, well, they do share buybacks, returning excess cash to your pockets. 1.22 billion shares outstanding in 2013, 971 in 2022. Now, if that still isn't enough for you, or how about the ROIC, which for me, it has to be around 10% or more for the companies I invest in. Gives me faith that management are effectively allocating their capital. I mean, is there really much to say on here? We're looking at consistently around 50 to 60% year on year. We do see it dip slightly to 41% in COVID. But again, 41% for any other company, they would snatch your hand to get a chance to have an ROIC of 41%. 2023 expected to go even higher at 63%. Operating margin, free cash flow margin, these are machines. 55% nearly consecutively and consistently over the last 10 years. Free cash flow machine in the mid-40s, very, very positive. It allows companies like MasterCard to offer those really high dividend increases due to the fact with the high operating margin, their bottom line should also be very high, which is very, very strong for investors and the company itself. Finally, to top it all off, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This shows us the number of years it would take the company to pay off all of their debt net of cash on hand. 0.55 in 2022 basically shows us two things. One, the dividend safety, and two, the strength of the balance sheet. So we can see here very, very strong, and we can understand why for MasterCard this is a very safe company. Now, in terms of the valuation, let's run through and get to the intrinsic value. And as always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And finally, do click on that pinned comment below if you want to grab a copy of the intrinsic value calculator to get to the acceptable buy price of companies on your watch list and in your own portfolio. So we jump onto what is essentially the first model, which is Graham's valuation. However, for MasterCard, given it is a fast-growing company, double-digit increases year on year, this isn't relevant, so we will jump into the first model we're using, the multiples valuation model. Companies in a similar sector and size, Visa, Pfizer, we have their P multiple, we have their average multiplied by the earnings per share to give a stock price for MasterCard of $340. Now we can take a look at essentially the current trading price, and it's pretty much at that 52-week low. So based on that one model, it's showing us that MasterCard is essentially overvalued. But as always, we never rely on any model, and we'll draw our conclusions towards the end. One thing that we do see why this is essentially coming out significantly lower is because it does hold a fairly high PE in comparison to the other companies. Now, when we take a look at the dividend discount model, we have the yearly dividends, some very strong growth, what we love with this company. Average growth rate 15%. Forward looking, I've gone 7.5. As always, if you want to be more optimistic or pessimistic depending on your investment thesis, you can grab a copy of the model below and play around with these numbers. So this comes to a DDM price of $5, $6, $7. Now that is significantly higher than the current trading price and well above that 52-week high, which itself isn't far from the current trading price. So we have our first sign of undervaluation. We then move on to the third and final model, the DCF model, with these free cash flows year on year. Average growth rate at 12.8% with a forward-looking estimated 15% per analyst. With our discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. We have the DCF price of $486. Now again, some very strong upside to the current trading price at around 15%. So we do also have another sign of undervaluation. Now, the intrinsic value, for those that are new, is essentially the average of these three models that we have used in today's episode, coming to $464. Now, as always, if you're enjoying the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos before they drop. Now, margin of safety, we start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. A lot of people will say it hits their targets for MasterCard. Some people will even say MasterCard trades at a premium, they buy it at the intrinsic value. It really does come down to the investor and their thoughts and processes. So what we're essentially saying is pretty much up to $441, you are getting a 5% margin of safety. At 10%, around $417. So you could argue it isn't too far off. So you are probably, in my opinion, getting around 8 to 9% margin of safety with MasterCard. Personally, yes, it is one that I would love to have in my portfolio. It does have a very, very high growth rate, as we see on the dividend, as well as the share price return. I would like a larger margin of safety, potentially around 20% at $371, which is still within that 52-week range. Now, in terms of Wall Street and what they believe, well, they see upside to the current trading price at around $456, slightly lower than our intrinsic value, but they believe to hit this price over the next 12 months. So essentially what we're saying in conclusion for MasterCard is you're locking in around a 5 to 10% margin of safety based on our estimates and judgments, with Wall Street estimating between 5 to 10% upside over the next 12 months. As always though, let me know your thoughts in the comments below, whether MasterCard is one you're adding, whether you prefer it to Visa or vice versa. And as always, do smash that like button if you've enjoyed the content, hit the subscribe and bell button if you want to be continually notified, and don't forget, click on that pinned comment below so you can run your own company through the intrinsic value calculator to get to the acceptable buy price, whether it's your own company or in your portfolio. As always, have a great day and catch you on the next episode. Take care.